Hello and welcome into the KE Report. Chad and Corey here, getting an update from Nick Hodge, co-owner of Digest Publishing, and editor of Foundational Profits and Hodge Family Office. And Nick, it's always great to get you on the show once a month just to get your thoughts on the macroeconomic indicators that you're looking at, and then dive down, of course, like we always do, into the commodity sector and the resource stocks. I guess just kicking it off, we have to start with the market turbulence and volatility we've seen really from last week into this week. The end of last week, very dicey, a lot of markets pulling back. And then it really escalated on Monday in the US markets. The Canadian markets were closed on Monday for the holiday, but that really is stemming from the Japanese yen carry trade unwind, but also more fears of recession, also more expectations about what's going to happen with the Fed. There's a lot of different threads weaving into this narrative. How are you looking at this market correction in U.S. equities, Nick? And are you worried that it's a bigger correction, or is it just a normal corrective move from overbought positions?
I think normal corrective move, to give you a direct answer right off the top, which a lot of people don't like to do. But, more broadly, it's human nature to look for a reason, right? When the stock market goes down, especially when it's hit nearly 36 all-time record highs in 2024, and then you get into late summer and the VIX index goes to 60 for the first time since everyone thought the world was going to end because of COVID. And, collectively as a species, we start scratching our head looking for reasons. This time we landed on the Japanese yen carry trade, which of course is true. The Japanese interest rates have been down for a while. Nobody thought the Bank of Japan was going to raise interest rates. And so let's just explain a carry trade, because I feel like people just say that because they saw it in the headlines, but don't even know what it is. So, the yen has been weak. So people borrow in yen to invest in dollar denominated assets. So they get the perk of both the dollar denominated assets going up and the low end of borrowing cheaply on the yen. And they expected the Bank of Japan not to raise rates. Well, the Bank of Japan raised rates. And so what happens is all those people that were in that quote unquote carry trade that have to unwind their US denominated assets to buy back their yen so that they don't get penalized by the interest rate move there. And so that's what happened there. I wouldn't assign the blame to it, right? Bloomberg does, CNBC does, and certainly was a part. But, it was also earnings season. There was a big tech rollover. Warren Buffett dumped half his Apple stock. That's a big thing that's going on there. GDP numbers came out and the Fed had a meeting. So a ton of stuff going on, right? And also the market was super concentrated in the communications and tech sector, which we've been talking about for over a year in terms of the Magnificent Seven, et cetera. So those guys came to report. During earnings report, you get buyback blackouts. So those big tech companies aren't buying back their stock, which is another factor in this. And so all those sort of things converged. Now, I don't necessarily need to do a post-mortem. What we need to do is look forward and answer that last question. Is it the end times, or is it a pullback? And I think it's a pullback. So I'm not sure how long that's going to last. Time frames are always important. But what I saw is, the VIX come right back down to the 30 level in just a couple of days. And now I've seen 2 days of buying on Tuesday and Wednesday. We're going to get a Fed rate cut here. And then the actual data is okay, which is something I've been telling you guys over the past couple of months. Like, I hear people saying we're in a recession, and it's like, that is mathematically impossible. GDP just came out at 2.8%. Like, we can't be in a recession. So I think the data is slowing, like that growth isn't great. And I think that there's a little bit of disinflation out there, which the market doesn't like. And I think that was another contributing factor looking at the commodities, right? Copper going from 5 to 4 in a hurry. Oil breaking down, which I was wrong on, from above 80 to the low 70s. West Texas, I'm talking about. That goes into the PCE and the CPI numbers, and it causes them to disinflate. And the market doesn't like that. I've told you guys that inflation is okay as long as you get the growth with it. So you got a little bit of slowing growth. You got a little bit of disinflation. You got a little bit of yen carry trade. You got a little bit of Warren selling Apple. You got a little bit of tech buyback blackouts. And then you got the sell-off that we saw over the past couple of days. But yeah, I think once we get into the fall, once we get our rate cut, once we get into the October, November inflation numbers, which I think are going to start to go back up to 3% and above, I think we get back to more of a normalized market, certainly not VIX in the 50 or 60. And so I don't think it's end of times. I don't think it's a crash. I don't think it's a recession, but I do think it was a big rotation, and happy to talk about that more if you like in terms of sectors.
That's what I was going to ask you because as worried or as fearful as the markets have gotten, it wasn't just Monday. It's 3 weeks of a correction that kicked off the third quarter. We had a correction that kicked off the second quarter, and the S&P is down 10%, which is a lot for 3 weeks, but who knows? Maybe a bottom could have been found on that Monday with how quickly markets have rebounded. But that brings the question, rotation. Small caps were doing well. There's a couple pockets of other sectors that continue to do well. If you're not worried about just a broad-based market collapse here, where are the opportunities for investors?
Well, it's rate sensitivity, and then started sniffing this out earlier in the summer, right? We're expecting at least a quarter point rate cut in September, and now we're looking at a 50 basis point cut, and the market and pricing in even more than that in subsequent months. So I had already started looking at rate sensitive trades. Now, I guess let me take a step back first and assuage some fears and talk about managing money and portfolio construction, because when you run money is different than when you're philosophically thinking about running money. So over the past 3 weeks or the 3 days, whatever time frame you want to choose, me and the people that follow me in my long-term capital management product, we're still in about a quarter cash and 14% gold, and had been getting bigger in things like NextEra Energy, which I told you 3 weeks ago or 4 weeks ago, the last time we talked, which is the largest utility in the country, and getting bigger in things like REITs. So over the past couple of weeks, while the S&P has taken that 10% hit, and some of the former high-flying sectors like tech and communications have been hit harder than that, what's happened is on an allocation model, we've been in 45% cash, gold, REITs, and utilities. And so, yeah, some of our commodity related positions got whacked, to be sure, but on the whole, our portfolio didn't take as big of a hit as the VIX would imply or the S&P chart would imply, because of the weightings that we put in those different sectors. And so I think those rate sensitive trades are still a good place to be. I mean, let's start with gold. Gold is ultimately a rate sensitive trade, and I was telling you guys this a couple of weeks ago as well. If it's already done well, if it was already at 2,400 based on whatever Chinese buying, Middle East geopolitics stuff, etc. Of course, then, and that was with rates at 5%. Of course, a quarter point cut or a half a point cut is going to send gold above 2,400 to new all time highs. So that's a good place to start. Where's a place to be? As far as sectors of the S&P are concerned, there's 11 of those, and the ones that are rate sensitive, or the ones that are typically pointed to as havens, are real estate, utilities, and consumer staples, and those sectors have been doing okay. Staples more a haven than a rate sensitive trade. The numbers coming out of those groups have been okay. Like, we own a REIT that dabbles in senior housing and medical facilities, and crushed earnings this week. It went to all time highs. The same with, like, we own Kenvue, which is a Johnson & Johnson spin out that owns their big brands like Band-Aid and Neutrogena. Crushed earnings this week, right? And so those staples and real estate companies are doing okay. That's the place to be. So for long-term retirement or safe capital, and I think you guys understand that's how I do this. I run sort of two different baskets, right? The speculative side has been absolutely demolished, right? Because those are longer-term positions and are in various commodities, including uranium, copper, gold, et cetera. And so, there is no shelter from the storm in penny mining stocks when anything that's not nailed to the floor is getting sold in events like we've recently seen. But on the whole, if you're managing a macro portfolio or a long-term portfolio, it wasn't the end of the world over the past couple of weeks if you had started to do that rate sensitive rotation anyway. And then, I guess, to your point about the S&P coming down or being crashy, yeah, when you're concentrated in those sort of stocks, the Nvidias, the Apples, the Microsofts, there is some unwinding that has to happen, and that doesn't happen in a day, right? All the throwaway lines like it's August, people are at the beach, Europeans, et cetera, like that does take some time. And so I think that's what I'm saying when I say that I don't think this is a crash, but I don't know how long it's going to take. You could see a couple more weeks of volatility and selling before we ultimately level out. So not making rash moves is what I was writing to my people to this week, adjusting our price levels for where we'd like to buy additional positions, but I'm not panicking, and certainly enjoying the buoyancy or the safe harbor of cash, gold, and those rate sensitive positions.
Nick, I think that's a great summary on the rotation trade, and well done on getting positioned early and alerting our audience to it the last time we spoke about a month ago. And it brings up the broader discussion of the rate cutting cycle, I think when we talked last time, we were looking at September being the first potential cut, but that maybe there would only be one or two cuts and maybe not a series of cuts. Now the market has shifted its tenor once again, as it's really done the last 2 years, over to looking for a series of rate cuts. And this ties into what some people keep pointing to as you alluded to, like the recession watch is back on and people are worried about a contraction. It's hard to believe that we're in a recession, to your point about the GDP being at 2.8%. Also, the real estate market has been bouncing back. Also, manufacturing has actually improved the last 2 readings on those metrics. And so it's a mixed bag. There is some weakening job data and there is rising unemployment. And I think that fed into it, especially last week when we saw the jobs number. But how are you looking at this rate cutting cycle? And maybe speak to the idea of maybe that we're not in a recession yet, but there are some mixed data as far as the good and the bad in the macro.
Yeah, well, the K-shaped recovery is real, right? I mean, ongoing inflation has eaten into the household budget. As we know, people are pinching their pennies and tightening their belts, as it were. And if you look at the fast casual restaurant chain earnings and things like that, people aren't going out as much as they once did. People aren't, using rideshare platforms and Airbnb as much as they once did, showing me that, certainly the high interest rates have taken away the punch bowl in terms of, the lifestyle erosion for those that didn't have the means all along. And so I think you get that recession talk because people feel that pinch. Like small business earnings haven't been great, small business sentiment hasn't been great, but we're meddling along, right? Back to that 2.8%, back to that sort of 3% inflation. The data is okay, but it doesn't feel great. But feelings aren't what goes into the algorithm, right? The actual numbers are. And so that's what I mean by it's slow growth. It's, call it stagflation if you want. That's sort of the environment that we're in. And when you get those sort of feelings, when your small business is struggling or whatever it is, then you get that sort of, spill over into the zeitgeist of recession and economic slowdown talk. There's also, I hate to bring in politics, but we're in an election year, obviously, and there's a lot of like post-truth out there, right? Everybody is. This is nothing new, but I've really noticed it over the past couple of weeks. Every person and every idea and every policy contention immediately gets turned into a meme or a nickname, and you're not even sure like what it really is or what the person is even saying, or what the policy is meant to do. And so I just think there's a lot of common confusion out there. I'm thinking of like the bell curve, for example, and how people interpret things and how they absorb media. And so, but what I'm saying is, the economy is slowing, but it's not recessionary. We're getting a bit of disinflation that I think will pick back up later in the year. And then to the Fed. So I'm not a Fed head, and I'm not really great at forecasting the Fed, but I think the Fed reacts, and I think the Fed caters to elites more than the common person. And so I think they will cut in September. I mean, you're getting a half a point cut priced in right now. Do I have the data up? Yeah, 61% chance of a half point rate cut in September. And then if I click all the way out until January, there's a 50% chance that we've gotten 5 quarter point rate cuts by January. The market's pricing in. So I do think the Fed is going to cut. I'm not sure how fast it's going to be. I've said for a while that people forget that it was Mr. Trump who appointed Mr. Powell. Mr. Powell is not a Democrat. I don't think he's interested in helping them out. I don't think he's interested in being perceived as meddling in elections. And so I could see, a more tempered quarter point cut in September, and then after, the election, sustained cuts after that, no matter who the president is. So again, I'm not a Fed head, and I sort of don't try to hinge my analysis and allocation on what the Fed is going to do. But on the whole, which is where I do tend to make my decisions at the macro level, I see lower rates in the next 6 months for sure.
Yeah, I think you're right. No one knows to what extent those lower rates are going to be, but it does seem like the Fed's going to start cutting and let the data dictate just how much they cut. So I want to turn it back a little bit more to the markets. When you mentioned that the speculative side of your portfolio has struggled, a lot of our audience who's in a lot of the small resource stocks, man, they feel your pain as well. Do rate cuts bring back that speculative fervor for investors, or is this more a process where stuff needs to play through and it could actually take some time for the more speculative, high risk plays to take off?
That's a loaded and complex question that I'm not sure I can do justice to. Let me tell you what I'm doing and then see if you can extract some sort of answer based on that. I think it's going to be a rough second half of the year for some of these companies that failed to capitalize and that have, been victim of charts that go down and to the right. I just got my tuition bill for my 3 kids. It's due in 2 weeks, right? I might sell some stock to do that. If I do sell some stock, it's going to be my losing junior speculative positions, right? And to me, that indicates a kicking off even earlier of tax law selling than we've seen in previous years, right? And it used to be December, and then it was Thanksgiving, and then now it's Halloween and before. So that's one thing. The other thing is that there's and I've told you this before, there's quality speculations that I own that I'll continue to own. And so what I think this is a good chance to audit your portfolio, right? And I've been saying this for almost a year now, but there's no need to own the junior end of the spectrum that needs to continually raise or that hasn't, raised the correct and the right amount of capital to sustain themselves. And so if you are a speculator, I think you should be really excited because one, mining plays are working. Like the mining sector, I don't think is out of favor. Earnings are okay for those that produce. And, all the things are true that we all know about the fundamentals of the space and the need to replace reserves, et cetera. And now the majors are generating cash. So on the junior end of the spectrum, you only have to look at the guys and gals who are actually doing stuff and building real companies. And so in that respect, I think it's good for the junior end of the spectrum. Does a rate cut bring people into the junior end? I'm not sure that my brain allows the logic to work that way, but the way my brain does work is, if there is a wider sector rotation, right? If, Warren Buffett truly is done with tech, and we've talked about this rotation in general from a higher level, a 30,000 foot level, the transition of, things that when you drop on your foot, they actually hurt. Those things coming back into favor in a post, zero rate environment. I think that transition is real. I'm not sure if a September rate cut is the catalyst. I listen to interviews and I hear people talk, and I've said some of the things over the years too. I'm not sure if it's, $2,400 gold that brings people in, $2,500 gold. And I'm not sure it is a specific price level of a specific commodity that brings in the retail crowd. It's more of a tide change, right? You sit on the beach, you don't just say, oh, that boat went by, the tide's going to come in the next 5 minutes. That's not really how it works. The tide comes in gradually, right? Until all of a sudden you're sitting in your chair and your toes are getting wet. That's how it's going to be, I think, in the junior mining sector. It's going to take time, and there's not one specific catalyst that you can point to that's going to bring that capital in. But as these tech trades get unwound, as the fundamentals improve in the mining space because of, sustained higher commodity prices, $4 copper, $2,400 gold, $28 silver, et cetera, that water is going to come up to your junior toes eventually.
And that's a good analogy with the tide coming in, being a process, not an event. And yeah, you're so right. We kept hearing that when gold finally broke 2,000, that was going to be the ticker. And then it was 2,100. And then it's, hey, we just need to get above 2,250 and then 2,300 and 2,400. And so far, none of that has really tripped the trigger of bringing in massive amounts of generalists. But it's a process that when the momentum starts building, like you say, the tide comes in. I'd love you to contrast, though, how well gold is done as a metal versus the metals like silver and copper, and maybe tie that into the economic game theory, just because silver being a little bit more industrial focused than the precious metals, and copper being Dr. Copper, when you look at their performance and rolling over recently, it stands in stark contrast to how well gold's held up. What do you make of that scenario?
I mean, you just did it there. Silver is increasingly an industrial commodity. And if there's going to be, weakness, that goes to the, industrials and then materials first. Same with copper, and that's evident in copper's chart, now down closer to 4 and toggling around a 3 handle. And so, look, man, I woke up this morning and I saw some article about this cache of gold that was found in Europe, and it was like 2,400 years old or something. And it was, a cache of coins that was used to pay soldiers. And, that's why gold is what gold is, right? I mean, it's literally as old as Jesus in that respect. And so that's not going away, right? That's the bastion of stability, the foundation of global economic markets, if you will. And, and it's funny. I love having these talks. I've been watching Bloomberg the past couple of days because I always like the narratives that they have to come up with in during days like we've recently seen. And no mention of gold, right? Like you had the people in there talking about their REITs and their utilities and the safe haven trades and this and that. And I'm looking at gold near all-time record high prices up for the past 3 months. And I've probably watched 5 hours of Bloomberg in the past couple of days, and I don't think I've heard gold mentioned a single time. So anyway, Chad, that's the answer is gold is a financial instrument. Gold is a currency. And those other metals you mentioned are commodities and industrial inputs. And so we see gold in general, but we certainly see gold in times of tumult and instability and volatility. And you're seeing that here over the past week as well.
So is the opportunity still simply to put your money in gold or maybe some leveraged ETF to gold rather than the stocks?
I mean, for the time being, I think, yeah, cash and gold is an okay place to be, whether that's GLD or whether that's AAAU or whether that's one of the Sprott physical products. Yeah, the gold has been the stability, not the stocks.
Well, Nick, you'd also mentioned to us off mic that the industry is going to start bringing more tech into the equation as far as how you analyze companies. And you brought up MineHub as an example. I'd love you to speak to how technology will finally be getting applied more to the mining sector.
I'd love to, and thank you for the opportunity. So transparency and disclosure first. I'm a longtime supporter and financer of MineHub, and they've been at it for a while. This is a company that's using smart contracts, blockchain, AI, all the buzzwords to help mining companies track all their data, not just the shipments and things like that, but also emissions data and to a certain extent assay data, et cetera. And this is important for a lot of reasons. And I'll touch on just a couple briefly. I mean, we see the stories in the past couple of years about exchanges that have received fake metal, painted rocks showing up as nickel and copper. We've seen those stories. We're obviously familiar with BREX, the manipulation of assays. There's even been some events recently with companies like Red Pine where assays were being forged. And in general, the mining industry is just antiquated, right? Still a lot of paper and pencil, still a lot of spreadsheets, and it needs to be brought into the modern day. At the same time, there's increasing regulatory pressures on these companies to track their data in terms of emissions, right? And there's a lot that goes into that by in terms of tracking the equipment makers and the fuel that goes into them and the emissions, et cetera. It's a very complex problem, and it's being mandated. So starting in 2027, you got to have a battery passport in Europe to sell an electric car that says where the critical metals came from and how much carbon was emitted as you secured them, right? So all this data has to be tracked. There's a couple of companies that are in the mix doing this, and one is MineHub, and it's a very real deal. I mean, this is the technology and the backing comes from big companies like Wheaton and ING, and they're already servicing like Codelco, for example, which is the largest copper producer in the world. And the reason I think it's a good investment is one, because it's being increasingly mandated and adopted by the largest and most well-run mining companies in the world, but also, it's just time for this to happen, right? So, and it creates a flywheel effect. So this is the easy example. They onboard Codelco, right? Well, in order to track all of Codelco's, let's call it things, to keep it simple, their shipments, their receivables, their fuel use, they got to onboard all their partners, right? So they got to onboard their shipping companies, they got to onboard their equipment providers, the Caterpillars of the world, the Maersks, right? The shipping companies. And that becomes sort of a flywheel effect, right? Because once you onboard the next company, then that company has partners it works with that has to get onboarded into the platform. And so it creates a critical mass. And truly, it's a critical mass. The reason I wanted to talk about it this week is that MineHub has been generating record quarterly revenues for a year or better now. If you just go on their news tab on their website and scroll, you'll see record quarterly revenue, record quarterly revenue, record quarterly revenue. And they've been really close to self-funding. So there's a company called ABAX, which is run by a very smart individual called Josh Crum, who came in last week and did a share exchange deal with MineHub, essentially providing them the funding they needed to get to profitability. And ABAX owns a commodities exchange that's seeking to be the leading green commodities exchange in this, electrification transition, right? So it's a Singapore-based commodities exchange. They also are the largest shareholder in a company called Base Carbon. So you could see how this all plays together, why ABAX would provide capital to MineHub, right? In my mind, if they want to sell green copper on their commodities exchange, it makes all the sense in the world to get the copper verified as green using MineHub's data tracking technology. So anyway, MineHub shares doubled in the second quarter. They've obviously been weak over the past couple of weeks, but I think they have the capital they need now to get to the end of the funding runway, right? Which is always the harbinger of death in the junior space, is having to raise capital. And I'm not sure they're going to have to raise any more capital with this recent deal that was announced. And it's just a much bigger deal than that anyway, because I mentioned the battery passports in Europe. Like Volvo was already doing this, for example. They're already electric battery passport compliant. So this data is already being tracked. It's already happening. And again, it affects multiple spaces of the resource space: drilling, exploration, assays, emissions, production, shipping, et cetera. So very big opportunity. And it also takes some of the gray area, with the famous saying or line from Samuel Clemens is, a mine is a hole in the ground with a liar on the top. But I think this technology, instead of a single liar, it becomes a single point of truth, right? And I think that's one of the things that the industry has been missing for a long time.
You are right. Now, I know some people have turned away from the industry because of some of the issues that it's had with, I guess, just straight up honesty and ability to actually track where some of these products come from. Does this bring in more investors then, or is this more of a stock specific play that will take time to play out for the market to gain confidence in?
I think it does bring in more investors, because these are big conglomerates we're dealing with. So I mentioned ING, like that's not a mining company, right? That's a bank. And so some of the problem is the share level prices that prevent institutions from coming in, but some is the risk factor, the credit ratings, the transparency, et cetera. And if you can fix some of the latter things I just said there, then I think you bring in some of that more generalist money just by a function of it being more transparent and more credible.
Yeah, it ties into a lot of those funds' ESG initiatives too, because they can verify, like you say, the green metals movement and the energy transition theme, but also marry it with the different social governance policies that they have and the different ways of tracking the minerals. One more that we got to fit in here before we wrap, Nick, is uranium. We won't camp out here, but just your quick thoughts on it, because it shot up to some big levels in just May, and even the Sprott uranium mining ETF got up to all-time highs for that fund. It's only been in existence 4 years, but just a couple months ago. Since then, it's almost been chopped in half, and it's had a pretty rough go of it. Now it's only down about a third. What do you make of this rout in the uranium mining stocks? Do you think it's over soon, or do you think it still has legs to the downside?
I honestly don't know, Shad. So let's talk about uranium first. The price of uranium looks okay. If I put it in the chart, I was telling you a month ago that 82 or 83 was likely the bottom, and sure enough, we're at $81.50, I believe we're at. So that lines up on the chart perfectly with the lows that we saw last November. It seems like it wants to level out there. Just the price of uranium, I'm talking about the spot price. And that's an okay price. So that's the commodity. But when I look at the stocks, the URA, which you mentioned, for lack of a better term, it's a disaster. It's broken down through technical resistance. It's a bearish chart in the short term and the medium term. I think the answer depends on something that I can't know right now, and that's how long this episode of volatility lasts, right? Because while it has bounced back up, the URA I'm talking about to 24 or $25, those candles are really wide, and so I could see it turning around just as fast. So again, where does the rubber meet the road? It's what I'm doing. So long-term capital management, we had two positions on. We had one smaller company that we were flat to slightly up on. This is after taking profits on other uranium names earlier in the year, which I told you I did. And then we were also in one ETF. So I don't know. And it's okay to say I don't know. And so what I did is split the difference. I sold my individual equity flat, and I'll probably average down a bit on the ETF because I know I can get out of it in the long term. So that's an adequate answer for me. I don't know if it's an adequate answer for you or your readers, but short term is really tough to call looking at that URA chart. But longer term, the fundamentals are the fundamentals. And so I guess putting it succinctly, reducing my risk at the individual uranium company level, but still staying invested and even averaging down on the whole sector.
All right. Appreciate that update on the uranium stocks, how you're playing it, getting rid of the individual company risk and playing it through the ETF. A great strategy to employ. And we'll keep following along with all these markets, Nick. It's just great to get you on and picking your brain on what's happening, not just in the U.S. equity markets and in the macroeconomic world, but also what's happening in the commodities and resource stocks. And if people want to follow along with Nick's work and his partner Gerardo's work, definitely click on the link below this interview. It takes you over to Digest Publishing, and you can see all of the different offerings they have for people invested in both the general markets and the commodity sector. And Nick, looking forward to our next conversation.
Appreciate it, guys. Thanks.